On Business Incorporated today. South Africa inflation rate slows to lowest in months. Egyptian experts' remittances up by $3.3 billion. Kenya and Ethiopia to boost trade at new border. Hello and welcome to the program. I'm Ini John Mekwa. Well, let's start the program with market numbers. We kick off with the market numbers in Africa, and they were mostly mixed. Both South Africa and Nigeria's main index traded unchanged as intraday. Elsewhere, Egypt's primary gauge closed negative, down 0.22%, and Tuesday's trading was strongly positive, up by more than 2.4%. In the Middle East, trading was mostly mixed. The Abu Dhabi fell by 0.46%, while Dubai's index gained 0.87%. Elsewhere in the region, Saudi Arabia fell also 0.43%. Our Qatari index rose 0.12%. And this was at intraday. European markets were slightly higher this morning as investors monitored inflation data and looked ahead to the minutes from the Federal Reserve's latest meeting. But we have more coming from that region with Conrad. Conrad is joining us from Frankfurt. Hello, Conrad. Good afternoon.
Good afternoon. Thanks for having me back on Channels TV.
Good to have you. Well, European stock markets are hovering not far away from recent records in Frankfurt. Trading is driven by fresh numbers on factory orders. What's the latest on this?
Well, our Federal Statistics Office here in Germany came out with an update on the order book situation in the German manufacturing sector. The number is pretty good. The amount of unfilled orders at the moment is 17% above to where it was before the pandemic hit last year in February. The increase from May to June this year was 2.8%. Generally speaking, our manufacturers really have lots to do. The range of the stock in manufacturing is standing at 7 months. This range indicates for how many months businesses theoretically would have to produce goods until all orders on hand are filled. Now, this is positive news, of course. It all sounds positive. It's not 100% positive, though, because the order situation or the unfilled orders are so high in the German businesses because also of the shortage of supplies, the famous problems with the computer chips. If the businesses, if the manufacturers had all the supplies they need, this number would be smaller because they would be able to work on the jobs, on the open jobs more quickly and finish them more quickly.
And then we're hearing a lot about car summits. What's this about?
Yeah, the car summit is happening today. It's basically a video conference by the German Chancellor with members of the auto industry and the car suppliers. As you know, we've talked about it quite often. Our car makers are going through a huge process of transformation. Combustion engines are the technology of the past, while electric engines are soon going to be the new normal. And it's such an easy sentence to say, but for the people working in the industry, this means a lot. If you work in a car, for a car maker or for a supplier, the skills that you once learned, they're simply not useful anymore. You have to learn new skills. The businesses, many of them smaller and medium-sized companies in the supplying sector, you know, the backbone of the German industrial sector, they produce products that nobody needs anymore in the future, which caused a drop in the value of these companies. Of course, who wants to buy a company that produces old technology? This is what this huge transformation process is all about. And this is where the government wants to help. It wants to help with networking, with communications. That's what the Auto Summit today is about. But it also wants to spend money. About 1 billion euros at least is going to be spent on transformation projects for the sector.
All right, and we're hearing vaccination being made mandatory for travelers on Quantas Airline. Is there a possibility this spreading to Germany and Central Europe?
It depends on the country and it depends on the sector. Some of our countries here in Europe have bosses who have rights, a little bit like in the United States, where Facebook and Google are two examples where the companies forced or are forcing their employees to get the vaccine. Here in Europe, it's more the public sector that does this. In Italy, the teachers are supposed to take the jab before they return to their jobs after the summer holidays. Here in Germany, the army wants the soldiers to take the vaccine to be safe. Private companies here, in Germany at least, are pretty reluctant to force their employees to do things that they don't want to do. The general guideline is, if you want to take part in public life here in Germany, you either have to take the vaccine and, get the vaccine and get vaccinated, or you had the illness and are now immune to the virus, at least for a couple of months, or you take a test which proves that you are COVID negative. Up until recently, the cost for the test was paid for by the government. It was free. This is now ending. People have to pay for the tests themselves, which means, of course, that the authorities are putting some subtle or more than subtle pressure on people to actually take the vaccine because it's cheaper for people.
Than paying for the test. Well, countries are just developing ways to survive through COVID, and we do hope that the light is at the end of the tunnel. Thank you so much, Conrad, and enjoy the rest of your day.
You're welcome.
So let's move to the UK now. Travel stocks have been hit by rising fears over the fast-spreading Delta variant, with New Zealand saying it would return to lockdown after its first COVID case in 8 months. Hotel groups are leading the losses on the FTSE 100, with Premier Inn owner Whitebread losing 3% and Intercontinental Hotels shedding 2.2%. Britain Airways owner IAG lost 2.5%, while travel operator TUI tumbled 4% at intraday. Well, the FTSE All-Share Index shed 0.19%, FTSE 100 dipped 0.29%. Only the FTSE 250 was in the positive 0.35%. At the currencies market, it was all green. Against the dollar, the pound gained marginally 0.08%, more against the euro 0.12%, and against the Japanese yen, it was up 0.31%. Still in the UK, rail passengers may be hit by the largest rise in fares in a decade, with costs potentially being hiked by up to 4.8% next year. The potential increase, which is yet to be confirmed, could see the average annual season ticket price rise by £150 to £3,295 for commuters. Increases are usually linked to previous July's retail prices measure of inflation, which was confirmed as 3.8% for July 2021. Rail passenger groups have called for fares to be frozen in a bid to encourage passengers back into trains and to help commuters recover from the financial impact of the pandemic. No announcement has been made on what will happen to the fares next year, but ticket prices in England and Wales rose by an average of around 2.6% in March, representing RPI for July 2020 plus 1 percentage point. We go to Asia now, where stocks were higher today, with the Reserve Bank of New Zealand keeping interest rates unchanged despite expectations of hike. In Japan, the Nikkei 225 rose 0.59% to close at 27,585.91, while the Topix index climbed 0.44% on the day to 1,923.97. Mainland Chinese stocks closed higher. The Shanghai Composite gained 1.11% to 3,485.29, while the Shenzhen components rose 0.7% to 14,454.11. Hong Kong's Hang Seng Index was 0.35 higher as of the final hour of trading. South Korea's Kospi closed 0.5% higher, 3,158.93. The S&P AX 200 in Australia lagged as it finished the trading day 0.12% lower at 7,502.10. MCSI Broadex Index of Asia Pacific shares outside Japan traded 0.46% higher. To the United States now, where stock futures fell today, pointing to another day of declines for the Dow Jones Industrial Average after it snapped a 5-day winning streak yesterday. Dow futures shed 0.22%, S&P 500 futures lost 0.8%, and Nasdaq 100 futures fell slightly. But we have more on how the market closed yesterday with our correspondent in the United States, Maria Bird.
Stocks fell on Tuesday morning following weaker than expected July retail sales. The Commerce Department said that U.S. retail sales fell 1.1% last month, down from a gain of 0.7% in June and below the consensus forecast, which called for a decline of 0.3%. However, manufacturing data was positive. Investment strategists state that they wouldn't read too much into one day's movement in the markets. Instead, they will look at the cause of these: consumer sentiment being negative last week, Tuesday's retail sell-offs, the COVID resurgent. All of these things are playing on the investor psyche. A disappointing U.S. retail sales report from the Commerce Department served as a key source of concern for equity traders, with sales dropping 1.1% versus a 0.3% dip expected. A decline in Home Depot shares also weighed on the Dow after the home improvement giant posted second quarter comparable same-store sales that missed estimates. Investors are bracing for another set of potentially market-moving data and earnings on Wednesday. The next round of retailers, including Target and Lowe's, are set to report results before market open. The timing and scope of the eventual rollback of the Fed's highly accommodative monetary policies have been key questions going forward for the markets.
Well, that was Maria Bird, our United States correspondent, giving us how the market ended yesterday. In the oil market now, prices dipped today after a fifth day of declines, with investors worried about prospects for stronger fuel demand as the use of rail, air, and other forms of transport remain constrained amid surging COVID-19 cases worldwide. Brent crude was down 5 cents at $68.98 a barrel, having fallen 0.7% yesterday. U.S. oil lost 6 cents to $66.53 a barrel after dropping 1% in the previous session. In the United States, more supply is set to hit the market if official forecasts prove right. Gold prices were unchanged in early Asian trade as the precious metal was caught between a firmer dollar and safe haven demand driven by Delta coronavirus variant fears. Spot gold was flat at $1,785 per ounce after hitting its highest since the 6th of August at $1,795.25 on Tuesday. U.S. gold futures were flat at $1,787.20. SDP Gold Trust, the world's largest gold-backed exchange traded fund, said its holdings fell 0.3% to 1,017.14 tons on Tuesday from 1,020.63 tons on Monday. Silver rose 0.1% to $23.65 per ounce. Platinum rose 0.2% to $999.53 after falling 2.5% in the previous session. Palladium rose 1.1% to $2,516.22, having tumbled 4.5% yesterday. We'll take a break now. After that, we'll bring you stories from the African continent. Do stay with us. It's Business Incorporated on Channels Television. You're welcome back. You're watching Business Incorporated on Channels Television. Now, we're looking at ESG. ESG stands for Environmental and Social Governance. Now, investors are increasingly applying these non-financial factors as part of their analysis process. What will be the impact on the African continent as we see deforestation and biodiversity lose a major challenge at these times? Looking at the case studies of nature tech in action in Uganda's palm oil and West Africa's cocoa sectors. It shows how nature tech is being deployed by the different members of the ecosystem, including farmer organizations, traders, government, and investors. Well, to have this discussion and help us understand this even more, we have the Chief Narrative Officer of Cleos Advisory UK, that's Ted George. Hi, Ted. Good afternoon. Good to have you.
Great to be back.
So ESG is becoming mainstream as companies seek to make their business fully sustainable. What risks is there bringing for West African commodity producers and exporters?
Well, I think the risks are huge because, as you said, ESG is mainstream now. And if you look at commodity production and exports, it touches on all the three issues. On the environmental front, there's, of course, biodiversity loss, deforestation as well, which is, partly being caused by things like climate change and say, the illegal gold mining. And then when you look at the social side, we have issues like forced labor, which is a major concern, particularly when it comes to cocoa. And then, of course, corruption and fraud, which you get on the governance side. So the big risk here is if you look at countries like, for example, the European Union, they are discussing draconian new laws that will come in that will effectively ban all trade in commodities that are linked to forestry destruction and forced labor. And so the real risk here is that a lot of these companies could find they can no longer do business with other parts of the world. So huge risks here, and all companies need to go through this transition to really fully embrace ESG.
Yeah, seeing that the world is becoming more technology-driven now, how can technology be helped to help these companies meet up with their ESG commitments?
Well, it's truly incredible. This latest generation of technology, they call it nature tech or climate tech. Really, essentially what it is putting together existing technology in different ways. But to give you an example, you can be using satellite data, LiDAR, which is laser and radar data, as well as sensors on the ground. And you can immediately see areas where there is deforestation going. You can visualize all of this and say this area is protected, this farm specifically is encroached on the area. You can also spot, for example, where there are fires which are unauthorized going out, immediately send someone to do something about it. And when it comes to issues also like child labor and fraud, you have these amazing traceability tools nowadays. You can tell exactly where, for example, cocoa is made, and you can trace the beans from the moment they are deposited in a warehouse the whole way system to the chocolate bar at the end. So that gives you this kind of degree of insight that you can't possibly get with previous technology. And that's going to be into ESG. Companies need to prove that they are really trying to monitor what they're doing on each of these different indicators and doing something about it, rather than simply saying, I'm sorry, we didn't know.
And there's also using agri-tech to boost crop yields. Do we have examples of that in Africa so far?
Yes, I mean, there's quite an interesting company, a UK company called Outfield. They do a lot of work in South Africa and East Africa as well, particularly on orchards. And what they're able to do using drones with photographs and satellites as well is they can track specific areas of plantations. And they can say, for example, this bit of the plantation is too dry, it needs watering. These particular trees need spraying now. And more importantly, these other trees don't. You very often find when there is treatment with fertilizers, and some of which are toxic, you either do a whole crop or you don't do any at all. So it can be so much more efficient. Using this own data, you can even tell the exact right time to start picking certain crops as well. All of that translates into much lower losses, much higher yields. And if you bear in mind, something like 50% of crops on average in Africa are lost after they're produced. They are rot or they are picked at the wrong time. That can lead to a huge increase in output without actually having to use any more water or fertilizer or land.
Well, sounds really interesting, but how accessible are these innovative and technology, measures to both boost, the yields from agric and all that? How accessible is it on the continent in Africa?
Well, it really depends what you're talking about. I mean, when we talk about the high-level nature tech, which is using satellite data and artificial intelligence to crunch it all, that is quite expensive, it's true, although it's improving. But some of the things are relatively cheap. I mean, if you want to be able to use technology of drones to look at your crops, you can buy a drone off the shelf, as in you get it from Amazon or any major supplier anywhere in Africa, and you can have a company which will literally send the data to the drone, and it will just automatically fly off and do whatever prospection you want in terms of data. So it's becoming more affordable. Apps on phones now, you can use them to actually show your GPS position. You could prove exactly where your farm is, for example, stuff like that. So a lot of the technology is becoming cheaper. It's just the putting it all together, which is expensive at the moment. But I think we should expect that that is also going to go down in price as with technology, it simply becomes more powerful and easier to access.
Yeah, we do hope that we see maybe more supplies, more innovations will make it more accessible and cheaper for Africans. Thank you so much, Ted George, Chief Narrative Officer at Clear's Advisory UK, for sharing your thoughts with us this afternoon. So we'll move to South Africa now, where inflation rate fell to the lowest level in 3 months in July, giving the central bank more leeway to delay raising interest rates. Consumer prices rose 4.6% in July from a year-on-year, compared with 4.9% in June, and that's according to the Statistics South Africa. That was less than expected and takes it closer to 4.5 midpoints of the central bank's target range. The Monetary Policy Committee turned less hawkish on policy normalization at its meeting last month and warned that deadly riots in eastern KwaZulu-Natal province and the commercial hub of Gauteng would likely slow economic recovery. The MPC cut the key rate by 300 basis points from January to July last year to buffer the economy against the global fallout from the pandemic and the impact of local lockdown restrictions. Since the start of this year, none of the 5 MPC members have voted for further easing, and the panel has consistently indicated that the next move will be up. Still in South Africa, the Department of Trade, Industry and Competition, together with International Investment Bank, JP Morgan, has announced a 340 million rand investment program aimed at funding small and medium enterprises, mainly in industrial and green economy sectors. The DTIC approved equity equivalent investment program since the deployment of JP Morgan's initial 300 million rand through the fund and 40 million rand through the grant, and is expected to create a minimum of 1,000 jobs over 8 years. Trade and Industry Minister says that South Africa needs more jobs for young people and deeper levels of industrialization. This transaction will boost the country's localization efforts.
JP Morgan today becomes the first international investment bank to undertake an EEIP program alongside us through a 340 million rand commitment in grants and loans that has been projected by JP Morgan to potentially unlock and support up to 2 billion rand in capital for short, medium, and long-term funding over an 8-year period. The boost to manufacturing in particular is timely, as one of the key lessons of the COVID pandemic has been the value of countries having domestic industrial capabilities. The funding is intended to support small and medium-sized businesses in sectors of significant public importance, ranging from transactions in the green economy to funding for firms with manufacturing operations. South Africa needs more jobs for young people and deeper levels of industrialization. This transaction will therefore give a boost to the country's localization efforts, creating employment and helping to strengthen economic output. I welcome the commitment to the creation of 1,000 new jobs and the focus on supporting a segment of the market that is not adequately served by the financial system.
So we go to Egypt now, where data shows that remittances from Egyptians working abroad during the first 11 months of the fiscal year 2020 to 2021 rose by $3.3 billion, and that's compared to the same period, which is 2019 to 2020, representing an increase of 13%. The data also showed an increase in these transfers during May 2021 at an annual rate of 45.2% to record about $2.6 billion compared to $1.8 billion in May 2020. Remittances from Egyptians working abroad registered an increase of 10.5% during the year 2020 and reached about $29.6 billion by the end of last year. Egyptian expatriates send back billions of dollars a year in remittances, which is an important source of hard currency. And Kenya and Ethiopia now banking on the newly commissioned Moyale one-stop border post to boost trade between the two countries, with a keen eye on small traders. Operations at the facilities, both in Kenya and Ethiopia, have gained momentum since opening in June, with border officials clearing traffic, cargo, and persons from both countries now physically located on either side of the border. According to Ethiopia's Deputy Manager, Customs Operation, it's a process that's ongoing, and he hopes it will be concluded soon. so that friendly tariffs will be the norm. Well, that's it on the program. Thank you so much for watching. I'm Ini John Mekwa.